Well, we have reached the month of October, and we traditionally do tend to see a little bit of volatility in the month of October. I think I'd characterize that just as, investors are now beginning to cast their eyes to 2019 and asking themselves what they think that looks like. But we could also turn our eyes to the current macroeconomic backdrop. We have the Federal Reserve, who's been raising interest rates, and investors are concerned whether the rising interest rate environment is going to have a negative influence on the economy or economic growth. We can point to trade tensions with the U.S. and China. I'd also come back to a modest degree the current skirmish that's going on between Saudi Arabia and some of the other world countries as it relates to that journalist that's gone missing. And if tensions get greater, we just have to keep an eye on oil prices. So investors should be considering the stock market as a long-term investment and thinking about their prospects from that context alone. The U.S. Federal Reserve continues to raise rates. Why are they raising rates? They're raising rates because the economy is strong. We're through the period of extraordinary accommodations. So really what the Federal Reserve is trying to do is renormalize the level of interest rates that we had in prior cycles. So the Federal Reserve is going to continue on its path, and we don't think it's one to be overly concerned with. The other risk that we'd point to as well is the uncertainty around Brexit negotiations and what's going to happen with regards to those negotiations. But more importantly, how that's going to influence the growth prospects for Europe right now. So bringing that all in together with the Federal Reserve raising rates, concern around overall global growth, partly initiated by trade wars or trade sanctions, all that combined has caused the volatility that we're seeing today. Canada is actually trading at a 10% discount to its historical levels relative to the U.S. So when we compare and contrast Canada to the U.S., we actually think Canada looks like better value than the U.S. market does. And Canada does also have a positive earnings growth outlook as well. Similar fashion, mid to high single digits, but you're paying less for the Canadian market than you are for the U.S. market right now. So right now, in light of where the markets are, the current volatility, we continue to focus on the high quality investments that we always look at, strong balance sheets, prospects for earnings growth, reasonable valuation, and making sure that the companies that we're invested in are well positioned for the next 3 to 5 years. And I always love to remind investors that dividends are a great thing to have in your back pocket. Focus on quality companies with sustainable dividends is always an excellent tool to have in your investment portfolio.